Let's talk about one day, December 3rd, 2025. On that day, the entire financial world kind of held its breath. And it wasn't because of some big scandal or a company going bust. Nope. It was all because of a single number. A number that kicked off this wild chain reaction, creating three totally different worlds in the US, Asia, and Europe. So, let's break down how one little piece of data managed to change everything.
And this was it. Negative 32,000. On its own, it's just a number on a screen. But in the world of the global economy, this was the spark. This was the match that lit the fuse for an absolutely insane day of trading.
And look, this wasn't just another blip on the radar. Analysts were calling it a decisive macroeconomic shock. Why? Because it completely blew up what everyone, and I mean everyone, thought was going to happen next with the world's most powerful central bank.
So what exactly was this number? It was the surprise loss of 32,000 private sector jobs, all tucked away in the November ADP employment report. This was a huge miss, a really big deal, because economists were actually expecting a gain.
Now, for those of you who might not follow this stuff day to day, the ADP report is a huge deal. Think of it like a sneak peek into the health of the US job market. It drops a couple of days before the official government numbers, so traders are glued to it, trying to get a jump on what the Federal Reserve might do next.
Okay, and this is where things get, well, a little weird and totally counterintuitive. You'd think a big, unexpected job loss would be awful for the stock market, right? But in the US, the exact opposite happened. It's the classic, sometimes crazy, bad news is good news scenario.
Let's walk through the market's logic here, because it feels a bit backwards. First, the weak jobs data comes out. That screams to investors that the economy is slowing down, and fast. That, in turn, puts a ton of pressure on the Federal Reserve to jump in and cut interest rates. And lower rates? Well, that makes it cheaper for companies to borrow money and grow, which juices up their future profits. And if future profits look bigger, stock prices go up today. It's a simple but incredibly powerful chain reaction.
And boy, did the market react. It was immediate. Traders instantly started betting on an 88% chance that the Fed would cut rates at their next meeting. The conversation completely shifted. It wasn't if they would cut anymore, it was how much and for how long.
And you could see this play out in the stocks, big time. The whole S&P 500 index went up. But the real story is in those high-growth tech stocks. Companies like Serve Robotics and Tesla, whose valuations are all about giant profits way down the road, they just exploded. Why? Because when interest rates are lower, all that money they're expected to make in the future becomes a whole lot more valuable right now.
But of course, the stock market is just one piece of the puzzle. The idea that US interest rates were about to fall sent massive shockwaves through currencies and commodities too.
It was like a perfect domino effect. If the US is about to cut rates, well, holding US dollars suddenly isn't as appealing, so the dollar index dropped to its lowest point in months. Meanwhile, things that don't pay any interest, like gold, suddenly look way more attractive, so its price shot up. And crucially, the yield on government bonds, like the 10-year Treasury, fell, a direct reflection that investors were now expecting cheaper money ahead.
So the US story is pretty clear. Weak data, market rally. Got it. But this is where our one little number creates a fascinating split. The very same news produced wildly different results all around the globe.
So let's hop over to Japan, where the market heard the exact same news from the US, but it marched to the beat of a completely different drum.
And you can see the conflict right here. While the US was getting ready to hit the gas on stimulus, the Bank of Japan was signaling the complete opposite. You see, after decades of trying to fight off deflation with rock-bottom rates, they were finally seeing signs of life and were actually talking about raising them. So you've got two of the world's most important central banks officially moving in opposite directions.
And the result of that? Japan's main stock index, the Nikkei, had a fantastic day, rallying over 1.25%. Investors there weren't cheering for US weakness, they were cheering for their own economy's strength. It's a perfect case of local policy totally overpowering a global trend.
Okay, so we've seen divergence. Now let's talk about a crisis. Over in India, the global news was basically drowned out by a huge local problem.
This led to a really painful paradox. I mean, logically, you'd think, hey, a weaker US dollar? That's got to be a relief for a currency like the Indian rupee. But it just didn't matter. There was so much selling from foreign investors, plus worries about inflation and government debt. All of that was putting this immense pressure on the rupee.
The result was a brand new record low for the currency, crashing past 90 rupees to the dollar. This just goes to show that even a powerful global tailwind, like a falling dollar, can be completely steamrolled by strong local headwinds, like investors pulling their money out.
All right, our final stop is Europe. And the reaction here wasn't a rally or a crisis. It was more like a shrug. It was just muted and stuck.
The markets in Europe saw the U.S. rally, but they just couldn't join the party. It's like they got the invitation but had too many of their own problems to deal with. As the European Central Bank pointed out, they were being held back by a weak manufacturing sector, the drag from trade tariffs, and just general uncertainty about what was going on in the world.
And this chart just lays it all out, plain and simple. While the S&P 500 in the States ended the day up, the big European indexes like the UK's FTSE 100 and Germany's DAX actually finished slightly down. They were just stuck, unable to ride the wave from the US because their own economic issues were too big to ignore.
So after all that, what's the big picture? What does this all tell us? Well, the events of that one day point to a massive theme that's reshaping how the world invests, what people are calling the Great Decoupling.
Really, the main takeaway here is that we can't just assume what's good for the U.S. is good for everyone anymore. Central banks are all on their own paths now. Local conditions in places like India or Europe matter more than ever. The old playbook, the one where the whole global economy moved together, it's being rewritten, and that makes things a lot more complex and a lot more interesting for investors.
And that leaves us with this one huge question for the future. As the world's biggest economic engines, the US, Europe, Japan, are all pulling in different directions, are we watching the end of an era? Is the whole idea of one big, interconnected global economy a thing of the past? It's definitely something to think about.